Look, over the last 5 years, gold's underperformed the equity market a little bit as a result of the correction it had in 2013. Over the last 15 years, though, gold has not only performed or outperformed the Australian share market, but actually every major liquid asset class on the planet. And that outperformance has come through again this year. I think the relative performance between Aussie dollar gold and the ASX is now at about 18% year to date. So investors who have kept a position have done very well. On the news at night, we always see gold prices talked about in US dollars, but obviously it's the domestic price or the local price that counts for investors like self-managed super funds. So obviously whenever the Aussie dollar weakens, the Aussie dollar price of gold rises. So that's one of the beautiful attributes that it brings to a portfolio. It's a natural currency hedge in the portfolio by getting that exposure to gold or silver. So one of the main reasons sentiment towards precious metals globally is quite poor right now is everybody's expecting the Federal Reserve to hike interest rates maybe as soon as September, more likely December or early 2016. And there's an expectation that that hiking cycle will be bad for the gold price. The reality is, though, if you look at what happened between 1971 and 74, 76 and 80, and 2000 and 2007, those were three very serious hiking cycles by the Fed, and the gold price actually rose substantially in all three of those periods. So the Fed interest rate hike, when and if it does come, is no reason to be bearish on gold. Obviously, central banks still own sort of comfortably over 30,000 tonnes of gold, sort of underpinning their foreign exchange reserves, and developed market central banks like countries like the United States and many countries in Europe often own more than 50% of their foreign exchange reserves in gold. Emerging market central banks who used to sort of recycle their trade surpluses into US treasuries, European government bonds and the like, have been buying gold of late. Obviously the BRICS have as well. On aggregate, central banks are now buying 500 to 600 tonnes of gold a year. So they provide another element of support for the gold market that wasn't there when this bull market started back in 2000. So what we found, or if you look back at history, what actually occurred from basically the middle of the 1980s all the way up until the global financial crisis hit, central banks, whilst they maintained a large holding of gold, were actually divesting and were selling on average about 400 tonnes a year for a large part of that period. But as I said earlier, since the GFC hit, they've actually turned net buyers and are now picking up, the last year it was well over 500 tonnes if you include what China bought. As I say, on average, 400 to 500 tonnes a year of buying now. So it's been a major shift in the precious metal market, and it sort of reinforces the importance of gold ownership. Ultimately, central banks are in charge of our monetary system, and they still see it as incredibly prudent and important to hold gold as a strategic reserve asset.